we expect China to make changes and stop the unfair trade practices that they've participated in for decades. If there are no changes to the behavior of China and they don't stop the unfair trade practices, then we would move forward.
That was White House Press Secretary Sarah Huckabee Sanders yesterday weighing in on the Trump administration's tariff showdown with China. Futures this morning are bouncing, indicating we will see a higher opening for the broader averages as the momentum from the close yesterday continues and Washington and Beijing begin that negotiation. This follows another volatile trading day yesterday. The Dow plunged nearly 500 points shortly after the open, only to erase early losses and finish with that gain of 230 points, 700-point move. Joining us now to talk markets and investing today is Northern Trust Wealth Management Chief Investment Officer Katie Nixon. Katie, good to see you.
Nice to see you.
You've got $290 billion under management. You got to move money, allocate capital, even in this wild market. How do you do that today?
You know, indeed, it's kind of interesting, Maria, because we do have nearly $300 billion in assets under management, but a lot of it is for our private clients. And for our private clients that have set goals, we don't necessarily swing the portfolio around too much. We really align our asset strategies around their particular goals, which don't tend to change clearly as rapidly as the market does.
So where do you see growth right now and value in this market?
You know, we still like equities here, Maria. Clearly, what we've seen this year so far has been a decline in prices and an increase in expected earnings. So the valuation of the market has become a lot more palatable for investors, really suggesting that we'll have maybe better returns over the near term than we thought even at the beginning of the year. So we still think there's value in the equity market.
Katie, we see so much volatility, but what's the chief vulnerability to a real downtrend? I mean, something sticking around.
You know, we have a few risk cases, but I would say our primary risk case right now, clearly protectionism is on the front burner now. But I think what we're seeing, or especially over the last 24 hours, is that this is the beginning of the beginning of a probably prolonged discussion on tariffs and on trade reform. So that probably brings our main risk case back to the forefront, which is a Fed policy mistake. And I think focusing on interest rates and what the Fed will do will really lead the market. So if the Fed gets more aggressive, we heard, from Jamie Dimon in his letter that he worries that the Fed may have to get more aggressive than the market is expecting. Anything like that, I think, would really upend investor sentiment and really have a negative effect on the market, on both markets, the stock and the bond markets.
Next week is earnings week. What do you expect? Do you expect a big uptick? Should we get in if the retail investors watching right now? What should they do? You know,
we've already seen earnings estimates come up so far this year, which is actually quite unusual. Usually towards the end of the quarter, you see them soften a bit. But we've seen consistent increases in earnings estimates. Year-over-year estimates are topping about 18% right now. So we're expecting very, very strong earnings, really propelled by tax reform. So I think there'll be a lot of good news in this first quarter, and hopefully that will take some of the negative headlines off the front page and put some more positive fundamental headlines there, which will drive higher prices.
Yes, S&P 500 earnings expected to be up 16.5% for the quarter.
Yeah, and you're saying put focus on that. So then is it the focus been too much on these tech stocks that have just, are maybe time for correction for a lot of them?
They have been leading. They have been the darlings, certainly the growth stocks, they've had tons of momentum. So clearly they have been driving the market. And I think we're in a bit of a rotation right now. We might have gone through a natural rotation anyway at this point in the cycle. But I think some of the negative headlines around tech, whether it's Facebook or Amazon, have perhaps accelerated that rotation into some of the other sectors.
But you still own tech.
Of course we do.
Yeah.
Of course we do.
So the president's going to head to Virginia, West Virginia today for a roundtable event on the tax cuts and the jobs picture right now. People are talking about phase 2 of this tax cut plan. Do you want to see that? Does that give this market another leg up?
It probably gives the market another leg up. I'm not sure if it's really necessary at this point, Maria. Things are going pretty well, economically speaking. Fundamentally speaking, we're seeing companies bring many more dollars to the bottom line, really looking to invest money in CapEx, which has been missing, buying back stock, lots of shareholder-friendly things. So things are going well. So it's not necessary that we have phase 2, but I think certainly news of phase 2 would potentially move the market as well.
You know what I thought was interesting? We had the CEO of BNP Paribas on earlier today, Jean-Yves Filion, and he said he's seeing increasing number of clients go to Europe over the United States. Do you like Europe better than U.S. equities?
You know what, we do actually. We like Europe, and we like the emerging markets also, and a lot of it is a function of the fact that we've had such an outperformance by the U.S. market over the last several years.
So it's really valuation.
It's valuation, and also, you know, American investors have a home country bias, so they're reluctant to invest overseas, and so we have to sort of push them to be more of a global investor, which includes developed ex-U.S. and emerging markets.
Do you think, though, Katie, over time that the whole concern about tariffs is going to level out? If there's a policing that goes on, and so trade becomes more fair, it actually becomes more free in the long term. Isn't that really what could happen through all of this?
Ultimately, that's the goal, Governor. So I do think that we will see over time this tariff situation become less of a negative headline and more of an observation around how companies might reorient in terms of continuing to be profitable in this sort of new environment. But clearly, we need to address some of the issues that have been highlighted in the last 24 to 72 hours. And I think, again, it'll be a process. And I hope that the markets don't continue to be so reactive to that process as these headlines come out, because we know there's a lot going on under the hood here, and it's going to take quite some time.
Well, things have gotten better. We get the March jobs report due out tomorrow. You saw the ADP number earlier this week, 241,000 jobs created, according to ADP. And for Friday's report, we're looking at 193,000 jobs expected for the month of March, with the unemployment rate ticking down to 4%. What kind of market reaction do we get with that? And what's your take on jobs right now?
So hard to say, because ADP and the non-farm payrolls didn't exactly mesh last month.
True, yeah.
So we'll see. We're optimistic about the jobs number. I think what's going to be most interesting, Maria, and what investors are going to focus on is the wage inflation number.
Right. That's what you said earlier, Pete.
Right. And to your point earlier about what the biggest risk in the market is, it's the wage inflation number and then how the Fed may react to that wage inflation number. And we've got a lot of Fed speak going on in the next 24 hours, so it'll be interesting to see how that all plays out.
We'll watch. Katie, thanks for joining us.
Thank you.
Good to see you. Katie Nixon joining us there.